Most people new to investing all end up staring at the same thing sooner or later: a stock price on a screen, a number that looks either suspiciously cheap or uncomfortably expensive, and the thought hits them: am I paying a fair price here, or am I about to overpay? That question alone is the reason valuation tools exist, and one of the simplest, most widely used ways to answer it is something called the price-to-earnings ratio, or just the PE ratio. At its simplest, the PE ratio answers one basic idea: how much are people willing to pay today for the profits a company makes? It won't turn you into a professional investor overnight, but it will immediately give you a clearer way to think about stocks than guessing based on headlines or hype. Here's how it works. You take the stock's current price and divide it by earnings per share. Earnings per share is just the company's profit spread across each share of stock. When you divide the price by those earnings, you get a number that shows how much the market is paying for each dollar the company earns. So, if a stock trades at $60 and the company earned $3 per share last year, the P/E ratio is 20. In plain terms, investors are paying $20 for every $1 of annual profit. That's it. No magic, just a price tag on earnings. Now comes the part that confuses most beginners. Is a P/E of 20 good or bad? The truth is, that question by itself doesn't mean much. A P/E ratio isn't a report card. It doesn't come with a green light or a red flag attached. It only becomes useful when you compare it to something else, like the company's past PE, similar companies in the same industry, or the overall market. In general, a higher PE means investors expect faster growth. They're willing to pay more now because they believe earnings will grow later. A lower PE often means the opposite: slower growth, more risk, or uncertainty. But this is where many people mess up. A low PE doesn't automatically mean a stock is cheap, and a high PE doesn't automatically mean it's overpriced. Context matters because different industries live in completely different worlds. Technology companies, especially high-growth ones, usually trade at higher PE ratios because growth expectations are high. More mature businesses, like utilities or consumer staples, tend to have lower PE ratios because their growth is steady and predictable. Comparing those two directly doesn't make sense. It's like comparing a sports car and a delivery truck. They're built for different jobs. Think about it this way. A fast-growing tech company might trade at a high PE because investors expect earnings to explode over time. A long-established consumer brand might trade at a lower PE because it's already dominant and growing slowly. Neither number is wrong. Each one reflects a different story about the business. You'll also hear people talk about trailing PE and forward PE, and the difference matters. Trailing PE looks backward. It uses earnings from the past 12 months. Those numbers are real and reported, which makes trailing PE straightforward and objective. The downside is that it tells you where the company has been, not where it's going. Forward PE looks ahead. It's based on estimated earnings over the next year. If a company's forward PE is lower than its trailing PE, it usually means analysts expect earnings to grow. Investors might be paying a high price today, but that price could look more reasonable if profits increase. Of course, forecasts can be wrong, which is why forward PE should never be treated as a guarantee. The P/E ratio is popular because it's simple, but that simplicity is also its biggest weakness. It leaves out important details. For example, it doesn't tell you anything about debt. Two companies can have the same P/E, but one might be loaded with debt while the other has a strong balance sheet. From a risk standpoint, those are very different investments. P/E can also be misleading when earnings are distorted. One-time events, accounting changes, or temporary spikes in profits can make earnings look better than they really are, lowering the P/E and giving a false sense of value. And if a company isn't profitable at all, the P/E ratio becomes useless, which is why it doesn't work for many early-stage growth companies. This is why the P/E ratio should never be used alone. It's a lens, not a verdict. Smart investors use it alongside other factors like revenue growth, margins, cash flow, and overall financial health. The goal isn't to find one perfect number. It's to understand what the market expects and decide whether those expectations make sense. If you're just starting, the best way to use the PE ratio is as a filter. It helps you avoid extremes and ask better questions. Why is this stock priced higher than its peers? Why is that one cheaper? Over time, those questions build intuition. Investing isn't about finding shortcuts or magic formulas. It's about learning how to think clearly while others react emotionally. The PE ratio is one of the first tools that helps you do that, not because it's perfect, but because it forces you to slow down and think in terms of value instead of noise.